All right, we're watching stocks here as we've got a little bit of pressure on markets. Crypto getting hit. Strategy, aka MicroStrategy, down pretty big. But we've also got some earnings coming up. Tom White's with me, and Arun Sundaram joins me to talk Maplebear, another one with a couple different names to it. Instacart, we know, of course. It's been on a great run, Arun, from, what, $32 to $48. So what do we expect from these earnings?
Hey, Oliver. Yeah, and I think we expect a pretty solid Q4 earnings. We're expecting revenue growth of about 11%. Gross transaction value, which is the total value of all of Instacart orders, likely to increase about 9% in Q4, which is a strong number. Importantly, their GTV, or gross transaction value growth, is really driven by order growth, not necessarily higher prices or something like that. So they're still expanding across new retailers. They're also deepening penetration with existing customers, and that's driving more order growth. And that's exactly what investors want to see. In terms of the bottom line, we're expecting their EBITDA margins to be about 28%. Instacart is actually very, very profitable, much more profitable than Uber, DoorDash, and they're also free cash flow positive. They don't have much debt. They're buying back shares, so it's a lot to like about the company. But the where we could see a little bit of caution is in their outlook. We did see a lot of retailers caution conservatively for 2025, and we're expecting Instacart to probably do the same. And one of the reasons we have a hold rating on the stock is that the stock has had a decent run over the past year. And now its valuation gap to DoorDash and Uber is actually narrowing. It's still trading at a discount compared to DoorDash and Uber, but that valuation gap is narrowing. So that's why one of the reasons why we're neutral on the shares.
That's very helpful because it does seem like those are the companies that we should compare to here, as they all kind of answer the same demand from the consumer. So that valuation gap compared to the other business lines that, say, an Uber has, for DoorDash, maybe it's more kind of a linear thing. Sort of a one program, one service offering, whereas Uber's got some more diversity to it. How should the valuation compare then?
Yeah, so I mean, in one sense, Instacart is trading at a discount to both Uber and DoorDash, which we think makes sense because their growth is also slower than Uber and DoorDash. Instacart, they're growing GTV about 10% year over year. Whereas Uber and DoorDash, they're growing their GTV or orders by about 20% year over year. And over the last few years, Instacart's growth has slowed, especially since the onset of the pandemic. But at the other end of the argument is, like I said, Instacart's margins are much higher than Uber and DoorDash's. About mid 20% EBITDA margins for Instacart. Uber and DoorDash are in the low teens to about 15, 16% EBITDA margins. And one of the reasons why Instacart's margins are so much higher is because they specialize in grocery, which is large batch orders. Typically, their average order value is about $115. And when you're generating more of these large batch orders, you generate more efficiencies there versus like a DoorDash or Uber, where you have these smaller restaurant orders that are $10 to $20. It costs a little bit more there. You don't generate as much efficiencies there. So that's why Instacart's margins are much higher than those peers.
Interesting, makes sense. Okay, so there's some trade-offs in between the companies within this category. Thanks for the elucidation. Appreciate it, Arun. Thank you very much.
Sure. Yep.
Tom, let's trade.
Yep.
Given that take, the kind of neutral approach, what do you think?
Well, you expect a move. I mean, the option market's pricing about a plus or minus 9% move. Implied volatility levels elevated going into this
pretty
report.
Juicy for current.
Not surprising. And we've seen some outsized moves from some of the peers in this space, whether it was Uber to the downside post their earnings where it rebounded, and then DoorDash, which rallied to fresh all-time highs. So I looked at this from the perspective of I want to take advantage of the different implied volatility levels between the different option series. It created a strategy that I just need to move about that one standard deviation, about $4.50 either way on this one. So I looked at a double calendar position where I went out to the March 7th weekly options that expire in 10 days. And I'm going to buy the 45 strike put out of the money to the downside. And then on the upside, I'm going to buy the 54 strike call, a little bit more room to that upside based on the one standard deviation move that they're expecting. And then in the near term, February 28th weekly options, I'm going to sell those same strikes. The 54 call, sell that, and then sell the 45 strike. Put double calendar position, paying roughly about a 50-cent debit on it. There's your risk, $50 per spread. And you can see here from the risk profile, the apex of profitability is at or near either the 45 strike on the downside or the 54 strike on the upside. I've got a range probably between about $42 on the downside and about 59 on the upside to profit on this type of strategy. You're buying about an 81% implied volatility in those March 7th options, selling about 130%. So there's that vol dispersion there that lowers the input price or risk on this particular position, but looking for about a $4.5 move either way in the stock, taking advantage of positive time decay on this strategy also.
All right, so if you're looking for a move.
Yeah.
Okay. What about if you think the thing is just going to stay stuck?
Stay stuck, then you would probably sell the iron condor in that type of name where, hey, I can sell it out of the money put vertical, sell it out of the money call vertical, take advantage of a range bound type of position. This sets up, but this is a little bit cheaper because you're risking only $50 to make potential 100, 150 on this strategy if it goes at or near either one of those strikes. And as I mentioned, positive theta on this one as those near-term options that you sold on the February 28th weekly options decay at a faster pace than the ones that you bought in the March 7th weekly options.
Okay. All right. You do have a little extra one for us in DoorDash. Hit me real quick.
Yep. This one is the neutral strategy in DoorDash. Maybe it starts to consolidate after the nearly 60% run that we've seen so far. And so it looked out in the March 21st monthly cycle, so 24 days to expiration, where I'm going to sell an out-of-the-money put vertical. I'm going to sell the 185 puts, buy the 180 strike puts, short $5 wide. And then on the call side, I'm going to sell the 210 call, buy the 215 strike call. So a short $5 wide call vertical to the upside. You're collecting roughly about a $2 credit on it. That's what you can make on this trade. But because you're collecting that $2 credit, it takes your break evens down to 183 on the downside and 212 on the upside. So if you expect some consolidation over the next 3 weeks in DoorDash, this takes advantage of it. This is also a positive time decay or theta position because this contracts on a daily basis into expiration over the next 3.5 weeks.
Okay. Good approach. Kind of two similar types of things. It's just the other one for Cart has the two peaks to capitalize on a move.
And vol dispersion on that one.
Right. Okay. This one we're looking just straight range bound for DoorDash. Thanks, Tom. Thanks, Arun Sundaram.